Hey everybody, happy Friday. Chris McDonough, your lender for all over Colorado. Of course, coming to you with my Friday market update. And wow, big changes with conventional loans, and it is blowing up all over the news and social media. So much bad information out there and so hard to understand. So we're going to break it down so you understand and understand some of the myths that are out there right now. So let's start with what happened. There's big changes in what's called loan level pricing adjustments. Gosh, that right there is just confusing, right? Think of mortgages as something that falls along a scale. So people that get the best terms are going to be at the upper end of the scale. People that get the worst terms are going to be at the low end of the scale. And traditionally, we've had people with high credit. Our blue sticky is going to represent people with high credit and big down payments. They traditionally have gotten the best terms. But people with lower credit or maybe low credit and low down payment would get the worst terms. Well, this is where everything got shook up. So first of all, it is confusing, very confusing, and know that there are 200 different combinations of variables that will put you up or down on this scale. So in general, the first big change is that the floor got moved up. So people with low credit, maybe low down payment, they now get better terms. So in a way, think of the old floor right here. The worst terms that were out there just don't exist anymore. They're not there. And people with high credit and big down payment can get now worse terms. Depends, though, on some variables. So if you have good credit and large down payment, well, you could be moved down this scale. Your terms could get worse if you're not a first-time home buyer, or if your income is high, specifically above the area median income. In that case, your terms did get worse. Not to panic, not to make a big deal out of it. This gap right here is actually smaller than most intraday changes in the market. So it's not really as big a deal as people are making of it. But there are situations where lower income, low credit buyers can be moved up the scale and now get the best terms. So if the low credit buyer now is a first-time home buyer and is below the area median income, they now move up to the best terms. And so there is a situation where people with low credit can have better terms than people with high credit. But that's not the case. I'm not saying go tank your credit, guys. I've heard all kinds of crazy things out there. In general, it is always better to have good credit. Now, if you had good credit and you're a first-time home buyer and you're below the area median income, that's where people with high credit will slide back up to the top of the scale. So, in general, people with lower credit win, and in some cases, people with high credit are losing. Couple things to know. This was put in place by FHFA and Sandra Thompson, not the Biden administration. So FHFA, they put this in place a couple months ago, and they regulate Fannie Mae and Freddie Mac. So that's where this originated from. And we talk about, hey, there are situations where low credit can actually have better terms than high credit, but that is not across the board. And also talk about a foreclosure crisis. So that it couldn't be further from the truth. So the ability to qualify for a loan did not change, and we have some of the tightest standards ever right now. So it is very difficult to qualify for a loan, and this does not change the qualifications at all. So this will not cause a foreclosure crisis. This will not cause a whole bunch of new bad loans entering the system. In fact, I would argue it, in fact, reduces the chance of a foreclosure crisis, because now folks with lower credit have opportunities to get better terms, making it easier for them to pay their mortgage. So that's the quick rundown. If you like the video, click like. If you have questions about financing a home, please give us a call. Have a great weekend.